What is liquidity risk? The risk of failing to settle liabilities because of insufficient cash or liquid assets on hand can be narrowly defined as liquidity risk. Liquidity risk to a bank's earnings and capital arises from a bank's inability to meet obligations, expected or unexpected, when they come due. There are two primary types of liquidity risk. Funding liquidity risk is the inability to obtain the necessary funding at a reasonable cost. Asset liquidity risk is inability to liquidate assets as necessary at an acceptable price. Liquidity risk is measured with liquidity coverage ratio and net stable funding ratio under Basel III. The liquidity coverage ratio and the net stable funding ratio matrix are broadly intended to represent market liquidity risk and funding liquidity risk. The liquidity coverage ratio is calculated at the ratio of a bank stock or pool of high-quality liquid assets and its total net cash outflow projected over a 30-day period of liquidity stress. The net stable funding ratio is calculated as the ratio of a bank's available amount of stable funding and the amount of required stable funding over the next 12 months. The ratio must always be greater than 100%. Comprehensive Liquidity Assessment Review, or CLAR, is a part of the Dodd-Frank Act stress test, i.e. DFAST in the US. Unlike the CCAR, the results of the CLAR and their methodological framework are not made public. In general, there are four central topics that must be managed to effectively address enterprise-wide exposure to liquidity risk. 1. Market liquidity risk focuses on price changes and profit and loss impacts. 2. Funding liquidity risk addresses the cash flow estimation of assets and liabilities. 3. Liquidity stress testing considers a financial institution's ability in the absence of market or funding liquidity to meet obligations during periods of stress by accurately measuring the liquidity profile of the balance sheet at the enterprise-wide level. 4. Contingency planning uses the liquidity stress test findings to provide guidance about how to create a strategic plan, governance framework, and risk appetite. The liquidity of a bank is made of its reserves of cash and liquidity assets integrated through the time horizon by the expected cash outflow and inflows. The essential drivers to consider in liquidity stress test are those events that might impact these items. In particular, 1. The drop of the value of the securities in the bank's portfolio or a change in the contractual conditions of the repo market. 2. The ability of the bank to roll over the maturing wholesale debt, both to the form of bonds and in the form of interbank deposits. 3. An unexpected withdrawal of deposits by retail or non-financial corporation. 4. An extraordinary drawing of committed credit lines. Thank you for watching.